Hello, I'm Noel Lim on ASEAN Speaks by Maybank. Malaysia's general elections ended in hung parliament as no majority winner emerged, while Singapore's non-oil exports contracted for the first time in 2 years, showing early signs of a recession. Winson Phoon, head of fixed income research, speaks to our analysts.
Hi, good morning everyone. It's 8 o'clock on Monday. A quick recap for last week. Global stocks traded mixed. Hang Seng was up close to 4%, extending the month-to-date gains to more than 20%. The Euro Stoxx 50 was up by 1.5%, but on the other hand, the S&P 500 and Nikkei 225 indices were both down by close to 1%. Similarly, for ASEAN markets, the performance was mixed. Philippines and Singapore indices increased. Malaysia and Thailand were down, while Indonesia was almost flat for the week. On bonds, the 2-year yield jumped 20 bp last week due to hawkish comments by the Fed officials, especially St. Louis Fed President James Bullard, who is one of the most hawkish FOMC members, said that the FOMC should raise interest rate to at least 5 to 5.25% range. And in his presentation, he also showed a chart that interest rate could go up to 5 up to 7% calculated based on his Taylor's rule model under different scenarios. But despite so, the 10-year US yield was still holding up well. And because of this, the 210 curve, the yield curve inverted further, now at minus 70 bp, which is actually the deepest inversion since early 1980s, as US recession risks continue to grow. The US retail sales data remains strong, but housing market continue to weaken as home buyers are squeezed by high mortgage rates and home prices in the US are falling in recent months. And if you look at the commodity sector, the commodities that are sensitive to growth, such as copper and oil prices, declined last week. The West Texas Intermediate futures prices fell 10% to $80 a barrel. On FX, the ringgit extended the pre-election rally, strengthening versus the dollar last week to 4.56 and outperformed all Asian currency. In ASEAN central banks, Bank Indonesia hiked rate by 50 bp and Philippines BSP hiked by 75 bp. Both came in within market expectation. For Japan, core inflation accelerated to 3.6% year-on-year, which is the highest in 40 years. The Bank of Japan Governor Kuroda acknowledged that inflation can go higher, but he said ultra-low interest rate remains relevant. For China, the property stocks rally continued, adding to the gains in prior week following a package of measures announced by the government to support the real estate market. For Malaysia, election result came out with a hung parliament, and there's no single coalition commands a majority, which requires a minimum of 112 seats out of a total of 222. According to news report, political parties and coalitions that have large number of seats are requested to submit the list of MPs who can form a majority government and the name of Prime Minister candidate to the Palace by 2 p.m. today. Later, we have Suhaimi to comment on this. Looking ahead this week, we have central bank meetings from New Zealand and also Korea. Also on Thursday, we have the FOMC minutes, and of course, we'll continue to monitor Malaysia election, post-election updates. And this morning, we have Suhaimi and Anand on Malaysia election, Habin, Joey, and Dr. Zamros on ASEAN macro. Suhaimi also will share on US FOMC and also Fed funds rate views. Xiaoyang on Malaysia tourism, and also Jigar on sustainability research. Let's start with Suhaimi. About Malaysia election result, hung parliament. What is your thought on this and expectation over the next few days or weeks? Is it too early to gauge on macro policy impact?
Hi, Winson. Good morning, everyone. I guess I'll go straight into our point of view from macro perspective. For the time being, we make no changes. to our 2023 real GDP growth forecast of 4%, which is significantly down from the estimated 8% for this year, as we wait for news on the formation of the next government. At the same time, budget 2023 that was tabled on 7 October, just before Parliament was dissolved on 10th October, must be retabled. So there is the question of whether it will be the same or a different budget. I think to note, the Parliament must reconvene 120 days after the dissolution of the Parliament, so latest by 7th February next year. Should the budget 2023 is not retabled, debated and passed before the end of this year, then a special Parliament session needs to be called to table a supplementary budget to provide for government's essential expenditures like civil service salaries, pensions and debt servicing for early 2023. This is what happened in 1999. Similar situation. We have tabling of budget 2000, but then came the dissolution of Parliament to make way for the 10th general election. So I think right now that's a possibility of same scenario happen this time around. On macroeconomic policy, I would say the next government's medium-term fiscal policy will be key to watch in view of the populist manifestos by all coalitions, including measures to address the cost of living, welfare and social security and protection issues, education sector goodies, promises of better deals for Sabah and Sarawak, raising budget allocation for healthcare to 5% of GDP over the medium term from 1.8% of GDP in budget 2023, as well as a bunch of tax cuts and reliefs. But there are no details and explanation on how to finance these measures by any of the coalitions, whether they will involve tax measures like raising existing taxes, introducing new taxes, or reintroducing goods and services tax, whether it will involve trade-off in expenditure, like cutting spending some areas in exchange for the higher spending elsewhere. Although this option looks challenging since, for example, no coalition speaks of subsidy rationalization in their manifesto. Or will there be higher borrowings by the government at a time when government domestic debt currently is about 60-61% of GDP and not far off the statutory limit of 65% of GDP. And just to recap, the current medium-term fiscal target is to reduce budget deficit to 3.5% of GDP by 2025, compared with 5.8% of GDP estimated for this year and a slight drop to 5.5% of GDP next year.
Thanks, Suhaimi. I would like to bring in Anand about the impact on Malaysia equities. Anand, your thoughts? Is it good or bad in terms of the outcome?
Morning, guys. So I think the straightforward answer, it's bad. So I think, we were, as investors in Malaysia, we were already expecting a hung parliament scenario. I mean, that was the base case in the run-up to GE15. But I think the additional issue now, and it's a structural issue because it's not going to go away, is the strong showing by the Islamist Party PAS. That equates to a significant step up in the uncertainty and therefore the market's risk premium when you're talking about Malaysia's future political and policy direction. And this is regardless of which coalition prevails in forming the next government. When the Islamist Party has 20% of parliament now, they have a lot of sway over policies going forward, whichever coalition is in power. And that's going to be an overhang for the market. Now, obviously, the sin sectors are most clearly in the firing line, sectors like gaming and breweries, which have thrived in Malaysia for many decades, despite the majority Muslim population. They would now appear to be potentially at risk of further regulation, further taxes, or even elimination. For us, we've done our own elimination. We have removed Genting Malaysia and Heineken from our top picks for now, pending clarity on state and national level intentions. Because remember, even states can withdraw gaming licenses or operating licenses. Among other sectors, more muted sort of connotations for now banks potentially at risk of another loan moratorium, given the manifestos which have been published. And also East Malaysia as kingmaker again, some of the stocks there like construction, oil and gas could benefit from diverted developmental flows to that area. But overall, I think the market is going to labor under this religious discount for the foreseeable future.
Thanks, Anand. We'll move to ASEAN macro, starting with Habin on Singapore. Last week, the non-oil domestic exports and NODX fell in October, year on year, which is the first contraction in 2 years. What caused the decline? Is this a concern that it could be an early sign of possible recession?
Hey, hi, morning, Winson. Hi, everyone. Yeah, the non-oil domestic export contracted in October by 5.6%. And that's the first contraction since about 2 years ago in November 2020. Exports were weighed down by decline in both electronics and non-electronics. And I think that's a clear sign that global growth is grinding lower. Electronic exports is down 9.3% from a year ago. And non-electronics are down 4.5% with a big plunge in pharmaceuticals, which is down almost 35%. I think it was very clear which some of the markets that were driving exports lower. Exports to China is down 32%. But even some of the export countries to ASEAN countries seems to be waning. So I think that's something we have to watch. The drop in exports could be an early sign of a potential recession, I think, for next year, led by a downturn in manufacturing and trade-related services. So Singapore, historically has been a bit of a canary in a coal mine, and because of its openness, seems to feel the chill winds from slowing global growth a lot earlier. But I think even if a recession does materialize in Singapore, it's going to be feel kind of different because essentially it's looking like a two-sided economy. Because they are on one side, there are some sectors that would probably still do well with reopening, like hospitality, aviation, F&B, construction. I suspect will still expand at a healthy pace, even as some of the sectors contract. The manufacturing, the trade-related, the shipping stuff may contract. So, but I think, these are the early signs of a potential recession.
Thanks, Habib. We'll move to Joye on Indonesia. Last week, Indonesia exports and retail sales both eased for the month of October. What are the key drivers and will this affect our GDP forecast for Indonesia?
Morning, Winson. Morning, everyone. Yep. So Indonesia's export growth decelerated to a 20-month low of 12% in October from 20% in September. And that's, partly it's due to last year's high base effects, given the easing of commodity prices, especially coal. But we also see signs of easing external demand. Coal exports growth has eased to 36% from 64% in September. And this is partly due to the price effect, with prices having plunged by around 20% from the peak in early September, amid signs that supplies will be sufficient to meet winter demand for both Europe and Asia. Palm oil, which was a key driver of exports last year, has also been easing, reflecting the decline in prices, while exports of manufactured items like iron and steel was also nearly flat in October. Retail sales also continued to moderate, rising by 4.5% in October compared to 4.6% in September. And this was weighed down by the decline in fuel sales after the price hike in early September. Sales of fuel contracted for the first time since February 2021, and sales of household appliances and spare parts and accessories also fell more sharply. And we also saw a slowdown in sales of cultural and recreation products and apparel. We maintain our GDP growth forecast for now at 5.3% for this year. But this also pencils in a slower growth of around 5.2% in the fourth quarter compared to 5.7% in the third quarter. We are looking at GDP growth to ease to 5.1% next year, and that's factoring in a slowing of both external and domestic demand, the latter due to the impact of BI's policy tightening as well as higher fuel costs.
And speaking of Bank Indonesia tightening, last week, the central bank hiked rate by 50 bp, which is in line with market consensus. Why do you think BI hiked 50 instead of 25? And going forward, what is your expectation for, let's say, the next meeting in December, and also the terminal rate, as in how high interest rate can go for Indonesia?
Yeah, so last week was the third straight meeting of a 50 bips hike, and similar to the past two meetings, Governor Perry said that the decision was a front-loaded and preemptive forward-looking step to lower inflation expectations as well as to stabilize the rupiah. BI likely hiked by 50 bips instead of 25, given that the rupiah was underperforming regional peers. It's fallen by nearly 3% quarter to date against the USD. And we are looking at BI to hike by another 25 bips in the final meeting for this year on 22nd of December. That would bring the policy rate to 5.5%. And for 2023, we are looking at another 50 bips hike to 6%. That would be the highest level since the first half of 2019, given that the Fed is expected to hike by a larger 75 bips in 2023. While we expect inflation to peak early next year, BI will have to continue tightening to support the rupiah, given that BI's burden sharing program is also ending this year.
Thanks, Juyi. We'll move to Zamros, also on interest rate, but for the Philippines. Last week, the central bank BSP also raised its policy rate by 75 bps. And the total increase so far this year is 300 bips, which is the most aggressive ASEAN central bank, I would say. Zamros, why such an aggressive tightening, and how many more rate hikes do you expect this year and also next year?
Hi, morning, Winson. Morning, everyone. Yeah, BSP last week put up another 75 basis point rate hike. We pushed the policy rate to 5%. And this is the sixth rate hike so far this year with 300 basis point. We think that there are a few factors that contributed to the aggressive rate hike by the BSP. The first thing is the sharp rise in core inflation. In October, core inflation already at 5.9%, a surge from 5% in September, which clearly showing the strong pass-through of the higher food and energy prices on the inflation expectations in the Philippines. And this very much attributed to the second factor, which is on the strong GDP growth performance. Already in the third quarter this year, Philippines GDP expanded 7.6% year-on-year, which is higher than the market consensus of just 6.2%, which makes for the first 9 months of this year, the economy expanded at 7.7% year-on-year, much higher than what it was for the full of last year at 5.7%. And BSP is in the view that the sizable rate hike so far would able to helps the Philippines economy to insulate from the external headwinds and also to minimize the peso fluctuations. So overall, we are looking for another 50 basis point rate hike for the BSP. We will push the policy rate to 5.5% by the end of this year. And we expect BSP to keep that unchanged for next year. Winson.
Thanks, Zamros. And on this topic of rate hike, I would like to bring in Suhaimi again to comment on the US inflation and the views on Fed funds rate. Suhaimi, are you seeing any signs of inflation slowing, and whether this is sufficient for the Fed to pause, and how high the Fed funds rate can go?
Yeah, I guess recent inflation numbers coming up from US, in quotes, encouraging in the sense that in October, we see moderation in the consumer and producer prices over there. But CPI was 7.8% year-on-year, core CPI was 6.3% year-on-year, producer price index was 8% year-on-year. The reality is US inflation rate remains well above Fed's 2% target. Painfully aware of this, given that previously it misdiagnosed inflation as being transitory. Hence the need to bring inflation back in line to its target. Therefore, we experienced this aggressive rate hike by Fed so far. I think the messaging from FOMC meeting on 1st, 2nd November and comments by Fed's officials since then basically suggests that Fed is far from done with raising interest rates, and the talks of Fed pausing or nearing the end of its interest rate high cycle is premature. Furthermore, in our opinion, US inflation died from satisfactory as far as Fed is concerned, because when we look at the breakdown of inflation contribution by cost push and supply shock proxies like food, utilities, and transport, and demand pull inflation proxy, i.e. the rest of CPI components, the key factors contributing to the deceleration in US inflation in recent months is mainly private motor fuel part of transport component of CPI, reflecting the impact of easing in global crude oil price. But other proxies of cost push, supply shock, demand pull inflation in CPI remain persistent in our view. So I guess Fed will remain preoccupied with and focusing on taming inflation to the extent of willing to incur some pain and sacrifice on growth and unemployment. So at the next FOMC meeting on 13-14 December, we expect two things. Number one, Fed will raise the Fed fund rates by a slower pace of 50 basis points to 4.25% to 4.5% range. So that's down from the 4 rounds of 75 basis point hike previously between June and November. Secondly, Fed will revise its guidance on Fed fund rate or the dot plot to indicate a higher terminal rate of 5% to 5.25%, which we expect to be reached by springs next year, implying the current rate hike cycle will peak by FOMC meeting on either 21st, 22nd March next year or 2nd, 3rd May next year.
Thanks, Suhaimi. We'll move to Xiaoyang. Xiaoyang, you wrote a report assessing the impact on Malaysia tourism if China reopens its borders and the Chinese tourists return in 2024. Two questions here. How important are Chinese tourists to Malaysia tourism, and which sectors do you think will benefit more?
Hi, Winson. So Chinese tourists may not be so crucial to Malaysia's tourism industry relative to, say, Thailand's, but they do play an important part. In 2019, Chinese visitors to Malaysia hit a record 3.1 million and accounted for 12% of total visitor arrivals. Tourism receipts from Chinese visitors hit an eye-watering 15.3 billion ringgit, and average receipt per Chinese visitor to Malaysia nearly hit 5,000 ringgit. All these three statistics were record highs, so they are still an important part of Malaysia's tourism industry. Now, as we all know, COVID brought the tourism industry to its knees, but as the world reopened in the first half of this year, China was the outlier in keeping its borders largely closed. That said, we are seeing increasing signs that China will reopen its borders, albeit gradually, and this ought to benefit the aviation and gaming sectors. Of the two, we believe that the aviation sector will benefit more, as the gaming sector in Malaysia is likely driven by locals and not tourists, whether from China or elsewhere. Our research shows that Chinese tourists don't mind shelling out a bit more for airfares and beauty products. So traveling and shopping is really an aspirational goal for them, and this will definitely benefit the aviation sector more. We estimate that if Chinese tourists return to 2019 levels in 2024, our earnings estimates for Malaysia Airports and Capital A, which is formerly AirAsia Group, could be raised by at least 100 million ringgit, which will provide a nice bump to the earnings. So we have buy calls on both of them.
Thanks, Xiaoyang. We'll move to Jigar. Jigar, you wrote a sustainability report, and you mentioned that G20, G7, and ASEAN countries are lagging in terms of carbon emission reductions, and global efforts may fall short to prevent temperature from rising by more than 2 degrees. In the report, you mentioned nature-based solutions offers large opportunity within the voluntary carbon market to achieve net zero emission by 2050 to 60. Can you explain what does this mean, and also what are the key takeaways in the report?
Yeah, hi, thank you, and good morning. Essentially, our report aims to talk about net zero for the corporate and for the countries, which is so very essential to keep the global warming in check and not exceed the 1.5 degrees to 2 degree centigrade temperature rise. Current data suggests that post the COVID, this is on the increase. The emissions in 2022 seem to be on the record once again in the first half of the year. And the global warming situation, going by the natural catastrophe events, is also looking quite precarious. So clearly, when the emissions are not going down as much as they should, we need to resort to other measures. And one of the critical other measures could be voluntary carbon markets. And these voluntary carbon markets, we have seen a significant amount of development in the past 6 months to 1 year. And this is happening in the form of investment going into some of the key products such as nature-based solution, which is in the form of restoration of forests, which is in the form of carbon sequestration on farmlands, and use of technology in that. And this voluntary carbon markets could be quite an important driver of some of the gap that we see in terms of the annual reduction in emission that is required. ASEAN could be a big beneficiary in this because it is home to 15 to 20% of tropical forests globally, which could sequester a large amount of carbon. And a lot of additional work can be done over here. So that way it could be helping its own domestic companies in terms of developing those carbon offsets and meet their goals, at least in the near term to medium term. And at the same time could export it also, because I think there is a global uniform market that is developing for these credits, especially removal credits. So this is something which is also getting organized by way of formal exchanges. And we are seeing at least 8 exchanges come up in the next few months, and 8 have already come up globally. 4 of these are coming up in Asia. And there is also good amount of exchange participation in ASEAN through Bursa Malaysia's setup that is coming live very soon. Then Singapore already has, and Hong Kong also has. So clearly, this is going to drive the carbon pricing, which is and discovery, which is not there, I think, except in Singapore, in this part of the world. So it's something which will kickstart a good event in terms of the ASEAN companies and countries going ahead with the voluntary carbon market and net zero, achieving net zero in particular. So we think companies such as DBS, Bursa Malaysia, they stand to gain from this because they are taking steps to set up, and even SGX to set up these exchanges. And apart from this, even plantation companies which will have surplus land and who are having plans to sequester carbon would be big beneficiaries in time to come. So that's the overall take of our report.
Okay, thanks Jigar, and thanks everyone for joining the call. Have a good week.
Get specific advice from your trading rep and check out market insights on the Maybank Trade app. Keep calm and carry on. I'm Noel Lim on ASEAN Speaks by Maybank.